Good afternoon. My name is Carter. Today we'll be presenting our audit risk assessment and planning approach for AutoNation Incorporated for the year ended December 31st, 2025. Here's our agenda for today. We'll start with the purpose of the engagement, then provide background on AutoNation and key industry developments. From there, we'll discuss our financial statement level risk assessment, materiality, and tolerable misstatement. Finally, we'll walk through the highest level risk accounts and our planned audit responses. The purpose of this engagement is to support audit planning for AutoNation's 2025 financial statement audit. Specifically, our objective is to identify areas with an elevated risk of material misstatement and determine where substantive audit procedures should be expanded. This assessment draws on AutoNation's Form 10-K and 10-Q filings and considers industry trends affecting automotive retail and the results of analytical procedures documented in our working papers. Ultimately, this risk assessment ensures that audit resources are focused on the areas that matter most to financial statement users. And now to Jesus for a company background.
Thank you, Carter. So now going into the company overview. To start off the business overview, AutoNation is one of the largest automotive retailers in the United States, with a nationwide footprint concentrated primarily in the Sun Belt states. As of 2024, the company operated over 325 new vehicle franchises across more than 240 stores, representing 31 vehicle brands. In addition to vehicle sales, AutoNation generates revenue through parts and services operations, collision centers, auctions, mobile repair services, and finance and insurance products. This diversified operating model increases scale and revenue stability, but it also introduces accounting complexity, particularly as AutoNation expands beyond traditional retail operations. Now looking at some of the key industry changes. There are two major industry developments that directly affect this year's audit. First is the growing adoption of electrical vehicles, which is being driven not only by consumer demand, but also by regulation. For example, the California Air Resources Board has mandated that 100% of new passenger vehicles be zero emission by the 2035 model year. While many of the out-of-nation locations are in states like Florida and Texas that have not adopted these rules, the company maintains significant operations in states that have. This creates operational risks related to inventory mix, employee training, and capital investment. Second is the industry's increasing reliance on complex digital systems, particularly dealer management systems. In June 2024, a cybersecurity incident at CDK Global disrupted AutoNation's dealerships operations and forced the company to process transactions manually. This event is critical for an audit perspective, as it heightens the risk around data integrity, revenue completeness, and IT general controls. So now, going back to Carter.
Geographically, AutoNation operates entirely within the United States, with Florida, California, and Texas accounting for a majority of total revenue. From a segment perspective, AutoNation reports three auto retail segments: domestic, import, and premium luxury, as well as a fourth segment, AutoNation Finance. The retail segments account for vehicle sales, parts, service, and F&I products, while AutoNation Finance represents a strategic shift toward captive financing. This finance segment materially increases the company's financial complexity and introduces significant credit risk, which plays a central role in our risk assessment. Jesus.
So now litigation risk. AutoNation operates in a complex regulatory environment and faces ongoing litigation related to customer claims, which in our matters, and regulatory oversight. While management does not expect these matters to have a material adverse effect on financial conditions, outcomes cannot be predicted with certainty. Now looking at some other relevant information. Of particular importance is AutoNation's finance, which falls under the supervisory authority of the Consumer Financial Protections Bureau. From an audit standpoint, this reinforces the need to assess loss contingencies, disclosures, and compliance-related risks, especially within the finance operations. Now looking at the account level risk of materiality. So our overall audit approach is based on a moderate risk of material misstatements at the financial statement level. AutoNation is a mature public company and has received unqualified audit opinions for the past 3 years. However, inherent risk is relevant due to the significant operation failure caused by the 2024 cybersecurity incident. That event suggests potential weakness in IT general controls and increased audit risk in areas affected by manual processing, such as revenue and inventory. Because the disruption was isolated and the company otherwise has a stable operating history, we concluded that moderate rather than high risk assessment is appropriate. So now moving on to Zach.
Thank you, Jesus. For materiality, we selected income before income taxes as our benchmark because it is the key profitability metric most relevant to financial statement users in a cyclical industry like automotive retail. We applied a 5% benchmark to AutoNation's projected 2025 income before taxes of approximately $1 billion, resulting in a planning materiality of $50 million. Tolerable misstatement was set at 50% of planning materiality, or $25 million. This level reflects AutoNation's relatively stable operating history while still allowing sufficient audit precision in higher risk judgmental areas such as credit loss allowances, VIE consolidation, and goodwill impairment.
And now we're going to talk about the work papers a little bit. So firstly, we got to our income statement projections by using FactSet estimates, which aren't as detailed as the financials that AutoNation reports. So what we did was we took the contribution of new vehicle revenue to total revenue, used vehicle revenue to total revenue, and applied that kind of to costs as well. So in the first 9 months of 2025, new vehicle revenue accounted for nearly 49% of total revenue. And so we took the FactSet sales number and then multiplied that by that 49% to get what we believe will be the new vehicle revenue for the year. And we did that kind of across the board where it wasn't broken out more detailed. And then some other assumptions are detailed below as well. And so then for our income statement, as Zach mentioned, our overall materiality was 50 million. Our tolerable misstatement was 25 million. We didn't expect any major changes in significant vertical or horizontal analysis, so we chose 4% and 1% respectively. And so over here, these kind of formulas will say yes or no if this number is both greater than the tolerable misstatement and a greater change than expected, which was 4%. And then the vertical analysis, we had a similar formula here. The gray boxes over here to the right are either for summary accounts like total revenue or total cost of sales. And then the other gray boxes are conditional formatting for where there is no significant change in vertical or horizontal analysis. And then the rest of this is kind of the MD&A or notes or other relevant info that we found that kind of explains why that account may have seen a significant change year over year. Similar thing going on here with the balance sheet, but we don't project the end of year balance sheet, so we used the third quarter balance sheet, which was reviewed, not audited, but we're comparing that to last year's audited financials. These had many significant accounts, and we were able to reconcile most of them, although some of these smaller accounts that did have significant changes didn't have much commentary around maybe why those accounts saw significant changes. And then we'll talk about this a little bit more later, but we suggested some substantive analytical procedures, which we go through here on the gross profit trend analysis and the inventory turnover analysis.
For our identification of significant accounts, based on both quantitative and qualitative factors, we identified 4 accounts with the highest risk of material misstatement. First, auto loans receivable and the allowance for credit losses. Second, inventory. Third, goodwill and indefinite-lived intangible assets. And fourth, non-recourse debt related to consolidated VIE securitizations. These accounts involve either significant estimation uncertainty, complex valuation models, or substantial year-over-year changes which warrant elevated audit attention. Auto loans receivable represents the highest risk area in our assessment. The balance increased nearly 85% year over year, driven by the expansion of AutoNation Finance and increased financing penetration. This growth significantly elevates risk related to existence, valuation, and accuracy. In addition, this account is subject to the current expected credit loss model, which requires management to estimate lifetime credit losses using forward-looking assumptions. The involvement of VIE securitization structures further increases accounting complexity and judgment. Together, these factors create heightened risk around whether receivables are valid, collectible, and properly valued. To address this risk, the audit response would focus heavily on substantive testing. Planned procedures include loan-level testing, positive confirmations, and recalculation of interest income. We would also evaluate the reasonableness of CECL assumptions, including default rates, economic forecasts, and qualitative overlays. Additionally, testing would cover VIE consolidation entries and disclosures related to non-recourse securitizations to ensure compliance with complex accounting requirements and transparency for financial statement users.
Inventory is another significant risk area due to its size and sensitivity to market conditions. Although inventory increased only modestly year over year, it remains one of AutoNation's largest current assets. The normalization of used vehicle prices following pandemic-era volatility increases the risk that inventory may be overstated if net realizable value falls below cost. As a result, the key assertions at risk are existence and valuation, particularly for aging used vehicles. The audit response for inventory would include physical inventory observations at selected dealerships and reconciliation to floor plan financing records. We would perform lower of cost or net realizable value testing, inventory turnover analysis, and gross margin analytics. Inquiry with management regarding pricing strategies and markdown practices would also be critical to evaluating whether inventory is appropriately valued. As we included below, we included our graph from our inventory turnover analysis that we showed you in the work papers. As you'll notice, the inventory turnover ratio increased significantly in the years subsequent to COVID. This is because of the increased demand and correlated price increase with used vehicles, which meant that AutoNation was able to turn over their inventory more efficiently and hold less average inventory. And then in the recent years in 2024, you started to see it in 2023 as well, and we expect to see further declines in their inventory turnover ratio this year. That has normalized closer to pre-pandemic era inventory turnover.
Lastly, goodwill and indefinite-lived intangible assets present significant judgmental risk. Despite impairment charges, AutoNation reported a net increase in intangibles due to acquisitions of franchise rights. These assets require complex valuation models and assumptions about future cash flows, discount rates, and terminal values. Importantly, KPMG has identified the valuation of franchise rights as a critical audit matter in recent years, which further elevates audit risk in this area. In response, the audit would focus on evaluating impairment triggers and independently testing management's discounted cash flow models. This includes sensitivity analyses of key assumptions, reviewing the allocation of acquired franchise rights, and assessing whether disclosures adequately explain valuation judgments and risk. Given the subjectivity involved, professional skepticism is especially important in this area. In conclusion, while AutoNation is a mature company with a history of clean audit opinions, the expansion of AutoNation Finance and the prior year's cybersecurity incident meaningfully increased risks. Our assessment supports a moderate risk approach at the financial statement level, with audit effort concentrated on auto loans receivable, inventory, and goodwill and intangibles. The risk-based approach ensures that audit procedures are appropriately aligned with the areas most likely to impact the financial statements and the decisions of users.